Welcome to TiE Woman Investor Panel on what investors look for in startups. So, for introducing the panelist, I welcome our Executive Director, Divya. Ma'am, over to you, ma'am.
Thank you, Akasha, and good evening, everyone. Once again, and warm welcome for this panel discussion. And today's panel discussion is what investors look for in startups. And a special welcome to the moderator, distinguished panelists, and mentor. And one of the most important questions every entrepreneur asks is, what do investors really look for? And today's panel brings together experienced investors and ecosystem leaders who will share their thoughts on evaluating startups, identifying potential, and what founders can do to become truly investment ready. And we are honored to have with us Mr. Roy Varghese, founder and managing partner of Roy Varghese and Associates, and an angel investor at Kerala Angel Network, as the moderator for today's discussion. A chartered accountant with over 4 decades of experience in strategic finance, mergers and acquisitions, investment advisory, and business growth. Roy sir has mentored numerous entrepreneurs and startups, helping them build financially sustainable and investment-ready businesses. And joining Roy sir today are our distinguished panelists, Mr. Satish Ganeshan, partner at In44 Capital, who brings extensive experience in venture investing and supporting high growth startups, offering valuable insights into business models, market opportunities, and scalability. And Mr. Rajesh Menon, sourcing category manager, software SEI at GE Healthcare, and an angel investor at Kerala Angel Network, who combines corporate leadership with active startup investing, bringing practical perspectives on building scalable and investment-ready ventures. And Ms. Navina Reddy, consultant at Lead Angels, who has considerable experience in startup evaluation, fundraising, and the early stage investment ecosystem, supporting founders in strengthening their investment readiness and growth journey. To our moderator and distinguished panelists, thank you for taking time to be with us today and for sharing your valuable insights with the TiE Women Kerala 2026 cohort. We sincerely appreciate your support. And to all the participants, I encourage you to listen attentively, engage actively, and make the most of this opportunity by participating in the discussion and the Q&A. Without further ado, it's my pleasure to hand over the session to our moderator, Mr. Roy Varghese. Over to you, sir. Thank you very much.
Thank you, Divya, for the introduction, and welcome to all the participants. I'm lucky to be among the panel which all the 4 are personally known to me. That is a good thing as well as can be a challenge also. We will structure this 1 hour. First 5 minutes already the introduction is done. So we will have discussions for around 35 minutes among the panel, and then which will include 2-3 minutes rapid questions in the end, and a Q&A session which will be open for everybody at least for 15 minutes. So all panelists are very active in the startup ecosystem. 2 of them are part of funds, and 2 of us are part of angel networks as well as some way connected to the funds. So if you look at the startup ecosystem, the most important person or identity in the startup is the promoter, who is the typical founder. So, what are the traits an investor looks at a promoter? I will first start with the lady. Navina, your responses?
Promoter is the most important thing when it comes to early stage startups. So the one thing is definitely the vision they are bringing to the company. It might be an amazing invention, but you don't have a roadmap planned for it or a commercialization journey. How would that vision look like over next 5 years? Ideally, I suggest founders to have a vision till the exit that you provide to the investors. Investors, whoever are coming in, are primarily looking at one thing, that is, their future uh, returns on the investment. So you have to have that vision, at the same time give the same or able to visualize the same vision for the investors as well. That's one. And second is founder business fit. That is the most important thing. If you're working in a segment which is your strength, right, so that also gives a confidence that they can execute the plan that they have charted out for themselves. So these are the two important things that we see. And third one is the general uh, congeniality of the founder, how well they're getting along with their co-founders and team members. At the same time, the customers as well as their peers. So congeniality is the third thing that we generally look at in terms of evaluating a founder.
Thank you. Satish, you have had experience in the Mumbai market later on with the Chennai Angels and now,
Yes.
running your own fund. So, what are the key traits you look at a founder? I mean, the
Okay.
key traits.
So I think now let me sort of put out my experience. People look at whether the founders can relate to the business they are doing. And this is predominantly more relevant when you're doing in a B2B or technology-led business. Uh, if you come across many people who are in e-commerce, they will come with a pitch saying, okay, I face this problem, that's why I started it. That's not going to work in tech B2B. You will have to have technical knowledge. Have you worked in worked in the same industry for 4 years, 5 years to understand this problem, and whether you have the skill sets to solve that problem. A consumer guy, a sort of guy who was a commerce graduate or arts graduate can't go and solve a mechanical problem. So that's something we look at the technical capabilities of the founders. Second aspect, currently because we are focusing more on deep tech, single founder also it's very challenging because there are four different business functions and each are very critical. It's not that uh, one guy can manage everything. So for us, when we are looking at one multiple founders with different skill sets, and out of which one guy with technical skill set to understand the pain they are trying to solve. So these are two critical things we look at before even we go to any next level evaluation also.
Rajesh, you bring a lot of corporate experience, and GE is one company which nurses talents and then nurses startups also in a worldwide. So, what is your experience when some of your guys come and say that, look, I'm going the startup way? So, how do you think about that guy, or what is the uh, your gut feeling on that guy? How do you decide that this is the right founder?
So I just summarize it into three topics which I normally look at. The first one is the clarity of thought, right? The founder should be very clear about his vision and you should be able to communicate it well. A common sales pitch is if you cannot convince somebody confused, that doesn't work here. You should be able to convince, you should have that clarity of thought. The second one is again, what motivates the founder? I've seen many founders who come and say, I want to be my own boss, I want to work on my time. That doesn't work at all because when you are a startup founder, you are the boss to many other people. You are responsible for much more things than what you are as an employee. So, and everybody knows startup journey is not straightforward. It has lots of up and downs, and most people say it has more downs than ups. So if you don't have that core reason that motivates you to lead the startup, I won't trust in you. And just to add to a point which Navina raised on the congeniality part of it, one thing that we always look at is the coachability of a founder. I have seen many founders who come and they're very defensive, they're very aggressive, and they're like, I just want your money, I don't want anything else. But uh, we bring in a lot of experience through failures of other people, etc. So when we try to give you those lessons, the founder should be able to imbibe those lessons, make changes, because it's not just about the lessons. In a startup journey, you would have to maneuver, you would have to change your path many times. And if you are not coachable, if you're not adaptable to change, then if you'll be stubborn, then you will not reach anywhere. So these are the three things I would look for in a founder.
Thank you, Rajesh. Let me just summarize or give my thoughts also on it. All of you agreed that the startup, the founder should have the relevant experience, or at least even if he is fresh, he should be able to understand the domain well. That's one. Second is passion is good, but problem solving for the larger market is the essential thing. You may be a passionate singer, doesn't mean that you can solve all the delivery issues or scalability of music to the audience. So that is one. Second, but personally, I have something more to add. I always say that two things are very critical for the founder. One is we call it fire in the belly. He should be able to withstand the pressure of this startup journey. If you are not able to withstand the journey of the startup journey, that which I call fire in the belly. Second is, all of you mentioned that at some stage, the startup will pivot its ideas. So adaptability to pivot, because recently I was in a seminar where somebody was telling, who is a seasoned investor for the last 15 years, 90% of the startups he has invested has changed the business ideas over the first 5 years. So because market adaptability, pivoting is also very crucial. Thank you all for this agreeing on so many things about the startup founder. So let me just come to the next critical thing, which is the market. How do you assess the market? Because you can see, you can go to Google and say that this is 30 billion market. I am targeting India's 2% only. And we come in pitch decks, we come with a lot of figures, which are all taken from the Google or whatever is available in the media. So how do you assess the market, or what is the kind of problem you are looking at? This is a critical element when somebody gets into startup. Satish has mentioned it very clearly. It may be a problem for you, but it need not be the problem which the market wants. Satish, what is your take on this?
Okay, so the problem statement, which is where we come to the point whether that guy has worked in an industry to understand problem. What we have seen many guys, they take, because there are many government organizations also which sort of ends up giving their specific problem. They say, okay, this is a problem you try to solve, for which they say technology innovation is needed. But have you done a validation going in the market saying, okay, is there a ready buyer for that, or can you create a problem, commercialize that product is something critical. So I will give you an example. Okay, there was, I think last year we met a medtech company which was manufacturing a surgical helmet for orthopedic doctors. So those guys, product was good. The moment you say orthopedic, it's very big market. There's every hospital maybe making it crores of rupees every year, so it should be big market. But then when we did a bottom-up study, how many orthopedic or knee replacement surgeries happen in a year, and how much at high-end hospitals, the market itself was worth 40 crores only. So for a 40 crore company, as an angel, it may be good for a lifestyle business. From an angel investor, 40 crores doesn't give me sort of entice me to look at it also, because I may give you 10 crore, 20 crore valuation. I know you are not going to even achieve 50% of market share. So I may not be making money also. So while you look at the bigger market, but you need to people will end up looking at the medtech market rather than the specific use case. So slicing and dicing from a top down or bottom up approach is needed to understand where your exact market size it is, and which is where I think many startup founders initially lag. I'm sure most of them will have a pitch deck where there's, if they are into a consumer FMCG product, they'll say the Indian FMCG market is good, so much x thousand crores. But for your product, what's the market? Whether it's a specific use case, so what will be the potential market in India? That's many people don't do it, and which is where I think it's needed for founders to also understand कि, okay, if my market is not significant, then my money requirement should also be accordingly tapered down.
Understood. Understood. Well done. Navina, what is your take? Because lead invest and lead fund are AIF funds through which a lot of angels invest. You have a very large clientele. What is your take on this?
I concur with what Satish said. You have to be very clear about your market size. So many of the times, as in almost 80% of the pitch decks that we see, they just show as if entire world is their customers, but that's definitely not true, right? One example that I could think of in one of our portfolio companies where we recommended to change their pitch deck is something like they were doing organic detergent. It's an easy example for everyone to understand, like an organic detergent for children's clothes, right? It's hypoallergenic and stuff like that. So when they were talking about market, they were largely talking about market size as the detergent market size. But you have to be very precise as to what is your market. That is again kids clothing segment, or uh, kids and allied services, children and allied services segment. So that's what we have suggested. Though the market has looked small in the numbers, one is that investor would definitely appreciate your honesty when you're saying, my market size is this much, right? You're not bluffing around. You know what you're talking about is the impression that would, or the indication that would send to the investor. So from that end, this is one point that you need to look at, like instance where Satish said, when the market size itself is too small, your business can exist. It's a wonderful business for you to deal in that particular market size, but don't try to raise capital. So for you to plan your 5-year vision, as well as to my earlier indication, right? You have to be clear about your market size. If your current product portfolio doesn't have a larger market, you need to at least have a vision so as to capture a larger market in the coming years, or you will at least launch new products or innovate on new products with the fundraise, which will probably increase your market size by 10x. So that is something you have to be very clear at, that honesty only comes when you're honest to yourself about your market size. So yeah, that's generally my take. It's not intentionally that founders are doing this. It is just that when you're working on a product, you get so passionate about it and you feel like, oh, this is such an amazing product, everybody in the world would like to use the product. But a little reality check within the team, someone who is an aspirational and somebody who is more realistic, that combination of founders would always help for you to plan anything in future. Yeah.
Thank you, Navina. Rajesh, since you come with a strong industry background, these entry barriers are a major thing in the startup. I mean, when you get into the market, you will suddenly find that there are a lot of players. And how do you come and find? I mean, how can the founders have some idea what is the market? What are the entry barriers and those kinds of things?
See, it comes with a strong USP. So, like when you say, when you're, it comes from the idea stage, right? So when you have an idea and you said, why do you want to solve it? And that's because you find a gap in that market, And when you look at the existing products, you look at what is the gap that the other company is not able to fix, right? So there are certain conditions. So like I come from a healthcare industry. So healthcare industry, it leads us with people's lives and etc. So we have that amount of experience and that number of data points. So when somebody is trusting me with their life, I have to be that careful. So that's the USP that I bring, that my failure rates are very less and I have been able to do that. So when you enter into a market, your product should be capable enough to overcome that gap much better than somebody else is already, an established player is already doing. So when and it's very simple, right? In our common life, when you go to a supermarket, you might find a new product, whereas you would see a product from an ITC or an Unilever. There is some amount of trust that comes with that brand name. How did they build that trust? Okay, it could be the product quality, it could be the distribution, it could be their service. So that is the entry barrier that they've created. Now if your product can solve the gap much better than what these people are doing, then you would have a chance.
Thank you. See, when it comes to products or services, we come at startups at different stages. Some may be idea stage, some may be on MVP stage, some proof of concept tested and all. Some may be in the prototype stage, or if it is a service, in a different manner. So customers, scalability, differentiation, all these things. Navina, what is your take on this general thing, product, services, scalability? How do you look at startup or founders, whether this is the right one for me to invest, and at what stage? Because some may be in idea stage, some may be in MVP stage, some may be early traction, some may be recurring revenues. So how do you judge where should I enter or how should I enter?
Our thesis is a little more precise on that part, Roy sir. So we generally only invest post revenue sort of companies. We don't invest in idea stage, but we do track the companies from idea stage. There's 2-3 companies actually as we speak also that probably I know the founders or met the founders even before the company was incorporated, and from then I've been talking to them and I wouldn't be so precocious as to say guiding them, but more or less staying in touch with them to see what they are looking at, etc. So if the idea is good, definitely that's our jumping point, that we should see what they will do. But once they have some sort of a translated revenue and the product, at least the initial product is more or less commercialized, is when we come in. That's purely because that's only because that reduces our chances of startup mortality. That's one of the reasons. But in companies like a deep tech company, right, obviously you can't really ask for revenues just 1 year into operation. So we understand that as well. So deep tech companies, we do give a little leg room for them to operate even after our investment. Another important thing that we generally look at is, can we help the company in future? One of the important thesis is for us obviously is exits, because we deal with so many angel investors, right? Investment part is obviously we can get the investment, but exit is going to be the tough thing. So we generally chart out a very clear uh, path to the exit. Can we facilitate an exit to the investors, like let's say 5 years down the line? Do we at least have that idea? Is like an important factor we analyze. On scalability, that's where the investments in tech enabled companies come in. When it's tech enabled, the scalability automatically gets triggered at some point, right? Like if the product has come out to be really well, you will not have to go and find so many investors, or sorry, so many customers for you to so the word of mouth has a domino effect, and it just goes from there. So our important this thing is many a times big funds do have a stronger portfolio team than we do. So we are at least clear till the next fundraise. Are we sure a bigger fund is going to come in the next round at 18 months down the line and invest in this company? Is an important factor that we look at.
Thank you. Rajesh, can you give us your take on this?
See, again, like Navina said, we would also prefer to invest in a company which has some sort of a revenue. But personally, I have a different take. If I have to invest in an idea stage company, that idea needs to be really revolutionary. If somebody is coming and tell me I'm launching a perfume brand for say kids because the perfumes are all made for elders and I know this is a big market, then I would say thank you, I'm not interested. But I wish I had started my investment journey 10 years ago when Skyroot was taking place. I would have definitely taken a bet on Skyroot because that is nobody could even think of putting a private satellite, right? So if I have to take a bet on an idea stage, I would put in a small amount of money if the idea is really revolutionary. But for ideas which are solving some gaps in the existing market, etc., then there needs to be some sort of an revenue, even if it's a small amount.
Thank you. Thank you. And Satish, what has been your experience or what has been your investment thesis
Yeah,
on
okay.
this?
So like we don't have specific criteria that we will invest in this stage or that stage because we more look at risk return perspective. And if I have to have a decent or good returns, I should try to come at earliest stage possible. But having said that, I won't invest in an idea stage company because today's with AI, anyone can create a unique idea and sell it to you. So rather we will say, show me some work done. I won't say traction also. So and also given we work on very deep tech, so I can't expect them to have a commercialized or a revenues. By the time they have a revenue, they may be unicorn also. So I won't enter. So we look at rather than break that commercialized part to commercialize into various stages, see where they are, maybe a TRL 4 or 5, and that's when we look at it. So also there are sectors like medtech where I know if I have to invest, it has to be before the clinical validation. The moment they cross the clinical validation, it's beyond my ability to invest because the valuation will be significantly bumped up. Anything on deep tech, we look at some pilot revenues or one pilot's going on to say that there's some validation being done. Uh, at the end of the day, everyone would be happy if you get a good 5 crores, 6 crores revenue company at 20 crore, 30 crore valuation. People will be happy to look at it, but that's not bound to happen. So you have to take a bet depending on what will be if like Navina said, if the company can raise next round in 18 months or 24 months, what will be the bumper for me? And after another 2 years, can I get exit? That's something you always have to keep in mind before you look at the investment perspective.
So in short, you have to be ready for the 80-20 law.
Yes.
20% of your investments will bring the whole thing back and 80% will die.
Correct.
You are prepared for that.
Correct. So like I think everyone says like my one company should give the entire returns for the fund. So which is like if there's an investor who's investing all the startups we are showcasing, even one company should give returns for all the other investments.
Exactly. So let us move to another.
On the other side, Royji, I actually know one fund. I would not like to name it, but Agnikul literally saved their fund one. Like entire returns, I think they're sitting at like the industry best returns when it comes to
Yes, I know the fund.
Everyone knows the fund.
because of Agnikul. So
okay. Let us move to another area, which is very, very important because we come across a lot of these platforms which are running competitions and all modeled in a different way, a lot of investments being agreed. And an analysis I have seen recently that actually something like 20 to 25% only gets converted into real investments. Basically because the startups do not have compliance procedures, they do not have financial what you call management, proper financial management. Some of them, they don't have even proper books of accounts, because the promoter is a person who is running after the business. He doesn't, some of them do not even know that these are very important things. But when somebody is putting money from his pocket, he looks at the financials, he looks at whether you are compliant with the laws of the land and what are the risks if you are not compliant. So how do you see all these things? Because there are different stages in a startup journey, where when an investor comes out, they have a pitch, and then they get something called a term sheet, which contains a brief idea about what is the kind of investment the investor is trying to put, and what is the kind of caveats or covenants you are going to give, which translates later into a due diligence, and then later into a shareholders agreement between the investor and this. Rajesh, what has been your experience, or what are the red flags you see here?
I'll look at it in a different aspect, right? So when a founder starts, they have a lot of things to think about, right? They have an idea, then they have to convert it into a product. They might need to hire some people for expertise gaps. They have to acquire a customer. They have to convert it into product. So there are a lot of things that is on their mind. So one thing that always takes a back seat is the funding plan. So whenever they reach a certain stage and they need money to move ahead, then they decide, okay, let's raise funding, and then they start looking for investors and stuff. And that's where the points that you brought about becomes very important. That point of time, they would have found out, they instead of an company, they would have registered an LLP. So LLP cannot take funds. Then they would not have filed their income tax because they think, oh, there's only a small amount of income, or they are running on losses. We need not file our income tax returns, etc. And even compliance issues, all the GST filings, etc., etc. So once when we give a term sheet, etc., and then we start digging in, and then we find out that there are a lot of legal issues and financial compliance issues that actually prevent us from investing into that company. So that is so a founder should actually have a funding plan right from the beginning. Even when he's starting the company, he should have that. He should know what are the compliances and what are the financial due diligence questions that's going to come from him, and he needs to be well prepared. I've seen many companies, very well prepared companies. Once you sign the term sheet and you ask them, they just give you a link to the data room, and last 5 years financial data, every damn certificates, the Startup India certificate or METI certificate, Deepam certificate, anything that you use, they have it. And that's where firms like yours also come into picture. People may not have the expertise, so they should not shy away from hiring a proper financial consultant who would be able to guide them. And Indian system is a maze, right? You will get lost in that. So having an expert helping you would always be preferred.
Now that brings us to the point of you should have a very good mentor who can connect you to the right people, professionals to help you. Because you mentioned about the data room. See, our firm does a lot of due diligences for funds. So we know how prepared these people are at times, or how unprepared these people are at times. So some of them may be very compliant with the financial things, but your labor side laws would have been a total mess, because they would not have thought about that. And then there may be a key employees. So what is your arrangement with the key employees? How to ring fence them? Because they should not, if you lose that team, probably you will not be able to scale up the way which you are planning. So compliance in different ways, which is financial, regulatory, which includes labor, all those things. And some of the, I'll take first Satish take on that, and then I will come back.
Okay. So I cover both the compliance or your books, the DD part, as well as the mentor part. So I think having your books or your accounts in proper is the basic hygiene, I would say. It's like as individuals, how we maintain our hygiene. That's the basic for any company. To the extent how you're structuring your cap table, whether there's a founders agreement is there, whether there's an employment agreement standard is there. if everything is there, that also gives many investors a comfort. The guys, while the promoters may not, the business may not be to the extent I am looking at, but those guys are built. They are structurally strong enough to build the organization. So that gives a comfort also. And which many people don't do it. They think that's something I can do only when there's money is needed, and it's not otherwise it's not needed. I'll sort of give you an example also, which maybe deep tech company, while they got funded by another angel network, but that was a red flag for us. It was a deep tech company operating the ocean space, and they had three founders. With one they started in COVID. With one founder said, "Okay, once COVID ends, I will." He was sitting in US. I'll come back and join the company full time. So they distributed equally. But after COVID, he's within 2 years, he said, "Company is not scaling up. I'm at a sort of very cushy job. Why should I leave that and come back?" And these guys didn't have founders agreement. So given that there's a non-operating partner, how to handle this 1/3 equity? As investors, we will think that the guy who's not operating full time, he's an investor, not a founder. So for me, a non-participating guy, founder who's owning 33% and not contributing, is a red flag. So we didn't do the deal. And these are some things, if you had had basic hygiene at that point of time, or if you had a mentor at that point who would have advised this or red flags, will be critical. Coming to mentor, again, I would say, okay, as individuals, when we are in the thick of action, we don't have a 360 view. And you need someone who you can rely on, or who knows you well and can who has seen the ecosystem, who can give you a third person perspective. You may be thinking what you're doing is right, but may not be right. And every stage you need it. To the extent many CXOs of large corporates have mentor, they call them as executive coach or personal coach something. But end of the day, these are mentors / coaches only, and you need it at some point of time. Some people have only one guy, some people have 2-3%. So depending on what field issues they are facing, they will automatically go to that person and get a feedback so that they can act upon it.
Yes, I do agree, Satish. We have enough number of cases in a very large unicorns where the early founder with a small percentage, 5 or 10%, making all the trouble for the valuations when it comes to the investment in the later series. I also see, what you have said, this hygiene part, we call it the sanitization. Before you go to the real investor, please have your whole thing sanitized in a proper way. Navina, what has been your experience, or how do you view this?
There are three parts to the due diligence, right? When we do the due diligence, there are mistakes which have happened in an unknown fashion, which can be fixable. Like we can go back in, probably we can do some rectification on it, and it doesn't take much part of our time to go and fix it. Second is mistakes you have done unknowingly, and they're not fixable basically, or it will take a really lengthy amount of time for you to fix that. Third is mistakes that are done intentionally. So when the company falls into the third bucket, it's a clear rejection, not just for us. I'm sure it's no for any fund. That's one. And in the first category, when it's flexible, yes, we will give some time to go back, probably like a 2 months period before the actual money hits the bank for them to rectify those mistakes. We generally call them as conditions precedent. And second part is when the things are but there might be an impact on the valuation, because even the fund investing have to calibrate for their risk. Suddenly the risk has increased in the company, so there will be impact on the valuation. Second part, where there are happened unknowingly, but again, they can't be fixed. In that part, again, fund will do a risk benefit analysis and come to a conclusion whether they want to invest in the company or not. there'll be a heavy impact on the valuation. Maybe it will decrease even from the term sheet level, right? Also, what due diligence says is also about the diligence of the founders in a sense of how they are running the company. So, one example is if you have hired a shoddy financial advisor, that's where the mentor part comes in as well. It's very important to have mentors from a sector where, like, let's say you are a core techie guy and you don't know accounts, right? So probably it's better to have a good accounts person who is not an S-man to you. If there is something wrong happening, he has to pause you, pull you back, and say that what you're doing is not correct. You have to rectify or course correct immediately. So that sort of reality check, you should have somebody with you who will do that sort of a course correct for you. That's very important. Many of the times, what I've seen is, in the early stages, because they could not afford a good firm, they generally hire a smaller CA or somebody like an accountant or something, who generally only says yes to the founders. Like, a founder has asked me to file the GST, I'll file the GST. He's not looking at the accounts or invoices properly or doing any sanitization of the accounts per se before he files the GST. He just takes your invoices and does the GST. Same goes with TDS, right? So that having a person with you who says no to you and course corrects you is very important from the day zero of the company. It might be your co-founder, but it can be an external mentor as well. That's one. And agreement between co-founders is must. Even before you go to the fundraise, have an agreement between yourself. How would the equity work amongst the co-founders? Let's say if there is a good lever, bad lever situation, if in off case one of the founders is leaving the company, how would that situation play out? Like, all these scenarios have to be baked in, because again, we don't know what comes up in the future. It might sound a little grim, but we also recommend in the founders agreement to have, if there is an unfortunate demise of one of the founders, where does the equity of the founder go to? It doesn't, unfortunately, it doesn't go to next of kin. Whatever the vesting shares, a part of it goes to the next of kin, but again comes back into the company. So those sort of off cases or the fringe cases should also be baked into the founders agreement to avoid any future conflicts. To take it a step further, what I say is not just equity, even the roles and responsibilities had to be laid out clearly even before you seek funding. Satish mentioned there has to be two founders. That is something of that is an implicit uh, ask of many funds. It's not exactly written anywhere in their thesis that you should be two founders, but it's implicitly implied that if it's a startup, there should be two founders. So a founders agreement comes into picture. If you don't want your valuation to get impacted, your funding round to get cancelled in the last minute, have a good mentor so that you can avoid all these possible circumstances that makes it tough to move.
Thank you, Navina. My take on this is in due diligence reports, we normally say conditions precedent, because before the investment, these conditions have to be met. Condition subsequent, which means the investor can live with these things, but will give you a grace period to comply with it. And this shareholders agreement is sacrosanct, nothing without a shareholders agreement, because all the scenarios you people have mentioned could arise any point of time. And now our discussion time has come to an end. Let me just go through a quick rapid, I don't say fire round, rapid round. Questions first. Founder, single or multiple, or if it is multiple, what is the cap maximum you look at?
Multiple, maximum 4.
Rajesh.
I would say 3 actually.
Rajesh.
I would say 3. And if it is 2, 50-50 is a no. It has to be 51-49.
I agree.
Okay. which is your preference? Product companies or services companies or distribution or those kinds of companies?
Product.
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 Rajesh,
Product.
everybody is product because that's where the exponential growth takes place. Okay. At what stage would you? You have already said this, but whether it is idea, MVP, or traction stage entry.
MVP to traction.
Yeah, for us, depending on the segment, if it's more of with a less competitive market, then we can go for MVP as well. But let's say it's easy to get into that segment, then we look at the traction.
Rajesh.
If it's a revolutionary idea, I don't mind idea stage also, but not a big check.
Okay. Which sector are you seeing the growth? I have different sectors. Retail is there, EdTech is there, SaaS is there, deep tech is there, AI is there everywhere, and space tech.
Deep
So
tech.
Select two sectors.
I prefer deep tech. I prefer deep tech, med tech. If I can add one more, clean energy space.
Oh, okay, okay.
So I think
Same for me. Deep tech is something that we look at. Again, AI itself is not a sector. It's
Yes.
more of a tool
It is
that
everywhere
helps.
now.
Yeah, it's a tool that helps in a different segment. But creative use of AI to produce tools is something I'm a fan of, which is slowly replacing SaaS, I have to say now. So that's something even I look out for.
so. For me, it's deep tech, which again for me, us anything on manufacturing would we cover under deep tech only. That's one, and AI it's more horizontal rather than vertical AI.
Okay, okay. Thank you all. Let us move to the Q&A session. I think we have around 20 plus participants, 20 participants. So please ask questions. Open for questions.
Hi, sir. This is Hiba. Yeah,
Yes, please.
yeah, sir. I was in a sampling stage right now. I'm looking into an area like modest activewear. Okay, so listening to your conversation, I can feel like the technology side is more tend to this investor pitching, and also is my area is not a valid idea. Just want to understand.
Rajesh or who will take the question?
Hiba, thank you for asking that question. You're talking about more of direct to consumer products, especially in textiles. So if you're talking about innovation in the textile
Mm-hmm.
itself, then definitely I'm sure Satish will be excited to give you a call and ready
No,
to.
we don't.
If
We
you
don't.
want me to explain a bit, I can explain that as well for the understanding.
Okay. So Hiba, let me put it the other way around. Okay, if you see in the market investors, I would say there are more investors who are more keen to invest in consumer rather than deep tech.
Yeah.
It's just that I think here the panel is such that most of them have moved from consumer to deep tech, I would say. When you're doing a consumer, if you have to interest, it should want to grab the attention of the investors, you will have to map of the entire value chain and see how you are capturing a potential white space. You can't just say that it's a Me Too product. The moment you see Me Too, people will not start looking at it. So you will have to sort of slice and dice, saying this is the market I'm targeting. There are no competition, and hence I'm trying to build a product, and that's where people start looking at it. If you just say that I'm in this space, and because typically every space has competition. We don't say that even deep tech there's competition. It's just that you need to see what's your right to win in that market.
So even this market has some possibilities, right, to pitch in?
Yes.
Yes, Hiba. Actually, consumer is exciting. You'll get a lot more eyeballs towards your brand as well. But one thing I would like to suggest is, let's connect further and understand, but at the same time, in this segment, it's better to have traction before you, because it will also act like
I got the same advice from other sessions as well. So better to have a traction rather than directly pitching into the sampling stage. So I'm also waiting for that, ma'am.
Yeah.
I'll just
Thank
add
you so
one
much.
point here, right? So, see, today's market trend is changing in the consumer space. So, this one size fits all is no longer relevant. Every segmentation is happening. There is a separate product for Gen Z, there is a separate product for millennial, etc. So, premiumization and personalization is a trend that is happening. So, if you can target that particular segment, give them premium personal products, it has a market.
Segmentation is the key. Segmentation and specialization. And because we have recently come across a perfume brand which is doing wonderfully well, and a lot of investment is coming. Two young girls. But the whole thing is they have a product which is within 400 to 800 bracket rupees. So that's a mass market. So you have to find the right fit. That's I'm a fan of still fan of consumer investment because I understand it more.
Yeah, why I raised the question is like most of the discussions goes with the technical side of domain. So that's why.
Let me make it very clear. I mean, most of these retail and those kinds of investments, maybe 60 to 70% are linear growth.
Mm-hmm.
That may not be exponential growth where these private equities or venture capitals or angel investors may not come in. Most of this may be good with own capital as well as debt, so that you are comfortable with a linear growth and you are happy with that. But how to, probably a mentor can convince some of these startups that look, you are not the one which is growing from 1 to 100 within 3 years. You are the one which will travel from 1 to 10 within 3 years. So that is where the whole mentor comes in.
Thank you, sir. Yeah, got it.
Hi.
There is a question, what is the best way to do a market analysis? What is the typical approach?
At what stage are we going? That is also an important one that we need to answer. So, if you're at an idea stage, I always recommend to go on ground and talk to few of your target market persona, right? You would have decided who you want to target with your skill set. So, talk to few of them to understand this first, and based on that, you will basically sharpen the target market persona. From that analysis you can find your total market size. That is a approach I generally recommend for this thing. And at the same time, allied services, you can look at allied services where they are at, and what is the market size that they are targeting, and you'll have a rough idea as to how to approach the market from there. Satish?
Yeah. So Kabir, again, it depends on what type of idea it is. If you are disrupting an existing market, which means you already have a base to say, okay, this is a market, and then on that you can slice and dice saying that, okay, this is my ICP, and my ICP will be based on ICP and my product revenue, selling price. This is the potential market size. But if it's a new idea, then you will have to do a ground level market study. Like maybe when Skyroot started Skyroot or Agnicode, they would have not had any data. So they would have spoken with people in the industry saying, okay, what would the demand they are getting, ISRO is getting, or globally others are getting, and they may not be able to cater. So that sort of gives a base to build the idea. So it depends on industry to industry, whether it's a so I would say I will say, okay, we were looking at one company which was in the e-commerce analytics space. So you have the data from Shopify or Unicommerce or anywhere. What's the number of players which are there in the e-commerce. Now you have to identify for your product which are the price, which are the target customers you may they will who will buy it, and that gives you a potential ICP, and then on that you work out your sort of market sizing. And on maybe after that you say, okay, in first year I can reach this much, second year this much. So that's an easy way to understand rather than putting it just thinking Indian e-commerce market is this much and I will capture this much.
So I'll give two points on this. Okay, so one is most people want everything free, but if you actually want data, you would find there are reliable, predictable agencies in the market who do proper research. Foster Wheeler and stuff, they have sector-specific reports which give what is the growth rate, what is the trend, what is the disruption, etc. happening. So that can start as a starting point. But like Navina said, what you actually require is you need to be grounded and stay close to your customer as much as possible. I'll give a personal example. I have a friend of whom I know for 18 years. He's been building a product for 3 years. He spent more than 2 crores and he's been perfecting the product. He's not even went into a single customer because he says he's from the industry. He knows all the problems. And what happened is like last year, I ended up investing in a competitor company who had only 2 modules. But they had already gone to the customer. The customer was willing to pay for it, and the customer gave them more requirements, and they started building on that 2 modules. Whereas I have a friend who has 20 modules sitting for perfection, and he's not even talking to the customer. So, customer and the stakeholders would be your real, people who can actually give you all the data.
Thank you for the valuable insights.
Thank you. There is one more question. Is there any hesitation to invest in disruptive ideas?
So the question, we will need to understand what's disruptive also.
It only says disruptive ideas.
If you are saying that, can I sort of say,
it is from Kala. Can you explain?
Yes, sir. Hi, sir. We are from construction industry, and we are replacing the conventional foundation with a ready-made foundation. So, if that idea, some people may be very much. It's a disruptive idea because it will, for shallow foundation, this is the best thing because there is no excavation is not needed. Natural resources used is 50% less than conventional thing, and there is no water is required. There is no concrete is there outside. So it's altogether a disruptive one since it's in the field. So like that, if that idea, I want to know that I have heard somewhere that these disruptive ideas are not easily funded. So I want to know that.
Okay, so let me put it the other way. Okay, as investors, we would like to fund this idea, but the question is, does the market will be willing to accept this idea or not? Two questions, two points on that, because I know there's a company in Chennai which does 3D printing of houses till first floor. So ground plus one, they can do a 3D printing. You don't need any base or anything. But when you're doing putting it on a large scale where you're replacing slabs in large corporate, you will have to see your cost vis-a-vis what the current market cost is. Whether if you're cheaper, then only they will buy. I know there are very well-known real estate groups in Chennai. They tell subcontractors saying that can you construct a house for maybe ground plus 5 or 10-story building at 1,600 rupees, whereas the market says you can't construct anything at less than 1,900 or 2,000 rupees per square feet. So for them, it's always how cheaper it can be. So if you are not cheaper, it's not able to scale up. So you will have to, if you have to get funding also, you have to justify that my cost per square feet on a slab is cheaper compared to all the conventional or the existing prevalent technologies are there.
Kala, are you with the university, digital university?
No. I am from the industry actually.
Okay. And I think there is a similar thing which is happening somewhere there. Okay.
Where? Sorry.
At NIT, we have one of the other incubators. Okay.
Okay.
So I'll give two perspectives on this, okay? Because I've been on the opposite side as well. So I'm part of a startup which has a disruptive technology, and when we go to investors, investor says we'll invest if you have at least one customer. We have enough customers, but each customer says that I don't want to be a first customer, I'll be a second customer. So the risk-taking capacity is very less, and the number of people who takes that risk is very, very less. But now I'll go into the other side and then give you one example. Very recently, as of last week, if you again, I mentioned it once again, Skyroot. So if you see, one of the investors of Skyroot has been Solar Industries. So that is where the concept of a strategic investor comes in. So Solar Industries invested in Skyroot because they could also sell their propulsion systems. So they wanted to take a bet. So if you have a disruptive idea, one of the best option would be to find a strategic partner who would in the long term benefit from your. So if you for example, if you go to a construction company, they're a big construction company, and tell them that I have this technology, I can help you reduce your time on the foundation, etc., and to make this technology, can you give some money? They will give that money because tomorrow they will turn into a customer and then they benefit out of it. They won't mind taking a small hit on this.
Okay, sir. Thank you. Actually, we are traction. We are in traction, and we are looking for strategic partner as well. Okay.
Okay.
Thank you, sir. Thank you.
Please connect with Kerala Angel Network or Satish or even Navina. All of us.
All of you are happy to look at them.
Because we will be happy to look at it.
So would like to get your contact as well, sir.
Yeah,
Okay.
that of course your people, TiE people can give. Rajesh knows this very well because GE nurses so many small startups and strategically invest and become they acquire them or partner with them.
Awesome.
You were part of the HDFC Parivartan last year, right?
Yes, sir. Yes, sir. We have on it.
Okay.
Thank you.
So there is one from Rahul. Rahul, can you? I can't raise hand. Rahul, can you come up?
Sorry to interject, Roy, sir. I think Kabir's raised his hand since.
Oh yes, please. Yeah.
Hello, Kabir. First of all, thank you for giving me this chance. I'm Kabir from Mirrorfolio. I want to start with introducing my startup. The Mirrorfolio actually started as a personal step. A few years ago, my grandfather suffered a stroke, and watching my family navigate his recovery at home made me realize how invisible recovery becomes once a patient leaves the hospital. Families are left guessing, clinicians lose visibility between visits, and small changes often go unnoticed until they become another emergency. That experience led us to speak with more than 350 families throughout Kerala, where one insight kept repeating itself. Most home monitoring solutions are designed for the caregiver, not the elderly person who has to live with them every day. So the caregiver gets the dashboard, the monitoring stuff, and all this kind, while the older adult is expected to wear another device or adopt another routine, something many naturally resist in our countryside. So we realized that the technology has to adapt to people, not the other way around. So that's what we are building. So Mirrorfolio is building the intelligence layer between hospital discharge.
Mr. Kabir, can you come to the question directly?
Yeah. So I want to come to this. So we are at our eighth prototype right now, and we have almost 20 families. We are waiting for our product, and as well as Kim's Health, also Astra DM are ready to partner with us for the post-discharge recovery programs. So yes, we are still in pre-revenue, and we are preparing for our first institutional round. But more than capital, we are looking for experienced people who can challenge our thinking and help us build something that truly matters. But I want to know, my actual question is, how should I approach for the initial funding at this time point? So basically, I'm at a confusion here. I'm not at an idea stage yet. I do have a customer interaction. Some people families are waiting for us. Some hospitals are ready to collaborate with us, but we are not yet. The product is not in the market yet. So at this point, how should I approach the initial funding?
Rajesh.
See, a common advice that I give to everybody in your stage particularly, where you have a product and you have the customer waiting, and all that you need is a funding required to move from the prototype into the real product, is first to approach friends and families. The reason why I say that is, if people who know you really well are not willing to take a bet on you, why should a person who doesn't know you take a bet on you?
Yeah.
Right. So
Yeah.
that's the first thing. And but again, it's not everybody won't have that kind of friends and families. Then that's the area where angels and angel networks come into picture. But the only thing that I would still say is that, then you shouldn't be actually going and asking for a 2-year runway or a 3-year runway. You should initially be willing to dilute a small stake where you get a small amount to convert this into a product and to show the traction in the market. And after that, and it works good for you as well. Once you have the traction in the market, and when you're raising the next bigger round, your valuation will also go. So raise a small amount just to convert it. Angels, angel networks, friends and families would be the right place to start.
Yeah.
Thank you. Thank you.
Can I get register 10-15 minutes somewhere around the time? So I want to, like, it's
I
not
think
a
offline you can connect with Rajesh.
Yeah.
Kabir, have you applied to all incubators where you get grants?
Yeah.
Because that's also a big potential funding pool.
Yeah, we just incubated IT Kottayam, and also part of CAMCT's incubation council. And post the medical validation is happening at INEST and CAMCT right now.
Okay. Any other questions?
Hello, can you hear me?
Yes.
Hello.
Yes, Rahul.
So good evening, everyone. My name is Rahul. Actually, I'm a first-time founder, so I just don't know a lot of things. So I made a notes about whatever you guys told me. The first thing that came into my mind, that some of the business are occasional and some can be funded. So, like, how do I know my business idea is fundable, or like it's an occasional business, I shouldn't raise a fund?
Basically, I would suggest that you prepare a business plan and then put your cash flows in a very conservative way, not in a very normal pitch decks or business plans. We say is all figures taken from the the Googles and all whatever is available in the internet. So be very conservative with your interaction with the customers and see whether you require funds at all. Sometimes you may not require funds. If you are in a service space, sometimes you may not require fund because you may be giving. And what is your bandwidth for scaling up? What is the team? All these things you have to start looking at and probably preparing a business plan. Then only you will know where you are standing and what you are up to. Satish?
Actually, sir, hello. Can I go forward and like extend my question?
Yeah.
Pardon?
So actually, the thing is, what we are building is it's like we can recycle any type of waste and convert them into something useful, like furniture and stuff, like your MLP waste, chips wrappers, and textile waste. And we actually filed the patent for it. We have filed the patent for the process and everything. And the furniture what we are building, it's like affordable than wooden furniture, and also has better strength and better capabilities than your wooden furniture. But the thing is, right now we are lacking funds. So should we raise money, or should we just wait and do more research and then go for funds?
So basically, you have to put your business plan and cash flows and see. Satish, you want to add?
Yeah. So Rahul, the question is, why do you need funding first? It's to scale up the business or do for more research?
Sir, right now I think we should focus on scaling.
So then in that case, which is where you need to say, okay, what type of setup you're doing. You need to have a factory. You need to have machineries or labor. What's your supply chain will be, whether you will be getting to pay upfront cash to buy. So these are things you will have to work out on a business plan. Then only you get to know, okay, how much funding you need. For scaling up, I know you may definitely everyone will need funding, but until unless you don't know if your supplier is giving you on credit for 1 year or 6 months and you are converting it on cash, then you may not need the money also immediately.
Yes, sir.
So maybe if you don't have that expertise, maybe sort of TiE guys can sort of connect you with someone who can help you on doing the business plan for you.
Okay. Thank you, sir.
Other questions?
No, sir. Thank you very much.
And anybody else? So Divya, I think we are done. Thank you, Satish, Rajesh, Navina, for the wonderful session. It was pleasure hosting you. And over to Divya.
Yeah, thank you. Thank you all for joining us today. Thank you for your time. And thank you, Roy sir, for moderating graciously this session. And thank you all the participants for joining us, and looking forward to our upcoming sessions, also your participation. Thanks a lot.
Thank you.
Have a great evening, and yeah.
Thank you.
Thanks.